Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. The Indian economy seems to be on a strong footing with the latest inflation and industrial production data suggesting that Indian consumers will get some relief as prices fall and the economy continues to grow. This at a time when the International Monetary Fund has said the Israel-Hamas war could spur a fresh round of inflation and hamper global growth if it turns into a wider conflict and leads to an oil price spiral. So how is the economic landscape looking like in India and the United States? What are the key risks that we need to be mindful about? Joining me now for answers to that and many more questions is one of India's top economic minds, Neelkanth Mishra, the Chief Economist at Axis Bank, part-time member of the Economic Advisory Council to the Prime Minister. He's also the chairperson of the UIDAI. Welcome, Neelkanth. Thank you very much for joining us. I want to begin today's conversation by getting you to decode for our audience what the latest data suggests. Inflation cooling to almost 5%, more than what was expected, while industrial growth is at a 14-month high. Help us understand what this data really means.
Yeah, thank you, Siddharth, for inviting me. Always a pleasure talking to you. On the inflation data, I think the headline decline was mostly because of fruit and vegetables. I think the more encouraging trend was that the core inflation drifted down a bit more. And while food prices tend to be volatile, some of them are very short cycle. The encouraging thing is that we have been below 5% for several months now on the core inflation side. And I think that should give us some comfort on medium-term inflation projections being anchored. On the IIP data, I mean, I've been saying for many years that it's completely disconnected from reality. So to be honest, I don't pay much heed to it. But I must say that directionally, what it is indicating is something that we see as well, that most indicators of construction, like cement volumes, cable and wires, tiles, PVC pipes, these are all showing resilience. In fact, September quarter numbers, September quarter volumes for many of these companies are likely to be quite strong. So if all of this is happening, we are seeing double-digit cement volume growth after nearly a decade. All of this is a sign that the economy is on a very sound footing.
If the economy is performing the way it is, what are the latest numbers that you are working with as far as full-year economic growth is concerned, Neelkanth?
So earlier in the year, earlier in this calendar year, December, January, it was fashionable to say that India's economy was going to slow. If you remember, fourth quarter FY23 growth was at that time expected to be in the 4.5% range. And everyone felt that 6% for FY24 was too strong and that it was more likely to be 5.5%. And I always felt that the 4.5% was misleading and that FY24 would turn out to be 7% plus. I still think that we are growing at that pace. Now, there are some apprehensions I have about the pace slowing down over the next 6 to 12 months, primarily because of global risks. So there are some domestic factors as well, but they're minor, which is that some of the infrastructure construction has been front-loaded by both central and state governments. But I think the bigger risk is in global export growth for goods and services starting to slow down even further from here. We have seen some marginally negative commentary from the IT services firms. And as the US heads into a recession next year, I think the headwinds to growth can become quite significant. So I do think that we will slow down from here, but closer to the 6.5% range after slowing as a run rate level. I think the full year number will still be closer to 7% or so.
Okay, that's a good assessment. And since you spoke about exports and IT, export numbers, viewers, the latest numbers, a dip in September. We are seeing exports down 2.6%. Imports are also down, and that clearly suggesting that the global economy continues to be under strain. And while Neelkanth spoke about IT results, the earnings season and some of the big IT results that we have seen so far also seem to suggest that there is strain that is feeding into from the advanced economies. Since we are speaking about the risks, I want you to help our viewers understand what's really happening in the United States. And as you do that, I just want to take a few numbers for our viewers to understand. It's been the worst day for the United States that we saw on Thursday, which is the bond market where higher than expected inflation has triggered a surge in the yields, viewers. The 30-year yield is up 19 basis points, the 10-year up 14 basis points, and yields have risen 5x to 4.7% from 0.84% in 3 years. Neelkanth, now all of this is bond data, and not every viewer of ours will perhaps fully appreciate what is happening. Please decode it for our viewers. What is really happening in the United States, and why are bond yields behaving in the fashion they are?
Yeah, no, I think this is the most important question for anyone in the financial market globally, because the yield on the 10-year government bond of the US is the risk-free rate, the long-term risk-free rate for the rest of the world. And the fact that yields are now meaningfully up from what we and the markets were used to in the prior decade is something that is very important, and it's worth understanding. So the first thing is that the policy preference for the US has inverted from a loose monetary, tight fiscal, so basically lower interest rates, but you try to bring down your fiscal deficit, which was adopted after the financial crisis in 2009, to loose fiscal and tight monetary stance that we are seeing right now. So they've been raising interest rates, but the fiscal deficit is not being brought down as much as it should be. Now, so therefore, when we think about interest rates, the muscle memory that most people have is that the interest rates will go down to the level that they were used to. That if inflation starts to normalize, the 10-year government bond yield in the US will also fall back to the 2.5 handle. I don't think that's going to happen. And the reason is that the increase, so the band was 2.5% between 2010 and 2020. It has now gone up to in the 4.5% range. And of that about 200 basis points, 2% point increase, only about 30-40 basis points is the implied increase in inflation expectations. So even if inflation was to normalize to say 2%, 2.5% in say year or so, even then yields will not come down significantly. Why have yields will they not come down? Because the demand supply for US government bonds has changed very meaningfully. See, for a long time, the price insensitive buyer of US government bonds, which is the central banks, right? So central banks like say PBOC, the People's Bank of China, Bank of Japan, Reserve Bank of India, all of these central banks, when they bought US government bonds, they were buying them for liquidity. That you wanted to show that you had reserves in case the country's currency came under attack, you would have assets that you could sell very easily. And the US government bond is one of the most liquid assets in the world. Now, the problem is that incrementally, some of these central banks are not buying US government bonds, but the supply of those bonds has gone up substantially. So as the private players start coming in, they are much more price sensitive. So as they start worrying about the US fiscal deficit, the change in stance, which is that they're tightening the monetary conditions and they're relaxing the fiscal conditions. What this has meant is that the supply of bonds has gone up and the demand for bonds has not, and therefore the prices fall, and which means that the yields start going up. Now, the problem is that in the last 1 year, if you think about the US economy and the expected recession, the recession that everyone expected would happen but never came, and in fact, this year's numbers have been pushed up. The expected deficit in the fiscal year that just ended in September was supposed to be $1 trillion, right? So when initially, it's a pretty large number to start with. It turned out to be $2 trillion. So the US government incurred an extra $1 trillion of deficit in the year that just went by. In a $27 trillion economy, that is 3.7% of GDP. If your fiscal deficit goes up by 3.7% of GDP, it is very hard for the economy to go into recession. So instead of growing in at a small pace, it has grown at about 2%. Now imagine if this fiscal stimulus is not there next year. The US, without that stimulus, because even if the deficit stays flat at this level, it's elevated level, nearly 8% of GDP, the economy will not get a fresh stimulus, and therefore the effect of the higher interest rates will push the economy into recession. One last point, and which is extremely worrying, is that the slippage on the fiscal front has occurred because of a shortfall in tax collection. So it is not because the government has been trying to spend too much. I mean, the fact that they've not curtailed their expenditure meaningfully is one thing, but versus the budget, the biggest surprise has been a shortfall in income tax collection. And the apprehension is that if next year, again, the inflation indexation is high, and if the US economy does go into recession, the fiscal deficit can actually expand even more from where it is. And what that means for the rest of us outside the US is that the risk-free rate, which is used to value financial assets, has to be raised meaningfully. So the price to earnings multiples that markets have become used to have to be revised downward, right? So the veterans in the market will remember that in 2010-11, 40-45 times on a consumer stock was considered expensive. And then over a period of time, that became 45-50, then 50-55, then 55-60. These days, it is very scary that you see a stock trading at 80 times going to 70 times, and people say, oh my God, it's become so cheap. But I think the anchor, the muscle memory of the market has to be sort of revised downward back to the era of higher interest rates and therefore much lower price to earnings multiples.
You have given us a comprehensive overview of what is happening in the US economy. What are the consequences likely to be for a country like India? While we are growing and we discuss some of the data as far as we are concerned, what are the spillover effects going to be?
It's a great question. So when the monetary policy is loose, the spillover effect is that the cost of capital in the rest of the world starts to come down. So if you are a steel manufacturer in India, if you are an oil refining company, a petrochemicals company in India, your revenues are effectively in dollars, and therefore you don't need to really hedge if you take a dollar loan. Your cost of capital comes down significantly. You can borrow at very low cost of capital. What also happens is that because you are having near zero cost of capital in the US, the flow into venture capital funds like high risk investments and private equity funds starts to go up. And that allows a very long gestation projects to get funded, very long gestation companies to get funded. When, on the other hand, your cost of capital in the US goes up as dramatically as it has done, the availability, so for example, already steel companies and fairly good quality steel companies are now saying that dollar bond or dollar funding is now almost not available. We've heard of advanced economy firms AA rated borrowing in double-digit interest rates in dollar terms. So the cost of capital for the whole world has already started to go up. So that's the first spillover effect. On the fiscal side, so if they have fiscal easing, so what that means is the US economy's demand remains resilient as it has been this year. It will not be the same next year when the fiscal deficit doesn't go up. But this year, it has supported the demand domestically in the US economy, and which means that their imports have been much more resilient than they would have been. If there is stronger wage growth, then economies like India, which are in the business of providing services or exporting services to the US, also benefit, right? So if the US wage growth remains high, the gap between Indian wages and the US wages expands. If job openings in the US or unfilled job openings remain elevated, then there's a lot more of skilled work that starts to come to India as well. So both of these, so the fiscal spillovers are generally positive for goods exporters like China, for services exporters like India. But the negative monetary spillovers, of course, are a drag for the rest of the world as well. So that's how I would see it. Now, next year, we could see a problem where the monetary conditions remain tight till the time that the US goes into recession, when, of course, the Fed will be forced to change its stance. But the likelihood of recession will mean that the risk appetite in financial markets goes down, and therefore the cost of capital goes up. And therefore, I think the markets will be very choppy next year, in my view.
Since we're talking about the cost of capital, for the wider audience that we have, does this mean that apart from domestic factors, and inflation is one of the key ones there, this would mean that interest rates will continue to remain high in India, and your home loan, auto loan, and other similar products will continue to be far more expensive than they were earlier?
That is my apprehension. Though that would have been the case even if the global cost of capital was not going up, because remember that the midpoint of inflation that the RBI targets, or the Monetary Policy Committee targets, is 4%. So it is not sufficient that inflation falls to 4% and they start cutting rates. Their target is 4 plus minus 2%. And therefore, they will have to, I think the trigger for starting to cut rates would only be when they see a visible sign that inflation is starting to fall below 4%, or meaningfully below 4%, and that's when they can start cutting rates. With what has happened on the bond index inclusion, so as your viewers will know as well, India has been included in the JP Morgan Emerging Markets Bond Index, which means that $25 billion will come, or is likely to come, starting June next year. Maybe there could be some front loading of that as well. Now, while this is very positive in an economy, in a global environment of significant turbulence, this is something that will further solidify India's position as an economy with good macroeconomic stability. What it also does is it in some ways links our rates to the US rate. So this is the one of the effects of opening up your capital account. So when you allow global capital to start coming in a bit more freely than it was earlier, your cost of capital in your economy starts to get at the margin more linked to the cost of capital globally, which is why what we have seen is that the 10-year bond yield in India, which everyone expected after inclusion in the index, or the announcement of inclusion in the index, the yields would come off, actually did not come off, because the US bond yield started going up. So that linkage, I think, it doesn't need to be very strong, because our capital account is not that open. But the fact that it is open will mean that the rates will remain elevated till the time that the US actually goes into recession. And in which case, once the recession happens, US rates come down, I think global inflation comes down, and then RBI will get an opportunity to cut rates as well. But that's some time away.
One of the negatives that we have been witnessing is in the IT sector with respect to employment. Data suggests that almost 25,000 jobs or thereabouts have been lost on account of the global conditions where IT companies are facing headwinds in key markets. One of the large IT companies has also said that it will not hire freshers this year. While that is specific to a sector, Neelkanth, does this really mean that as far as our economy being stable, our macroeconomy being stable, there are worries that we need to contend with?
Absolutely. So as our economy grows bigger, one necessary condition for the economy to really grow is that it becomes more open to the world. We are going to be, it's very hard to be completely isolated. And while many drivers of growth, starting with, say, real estate construction, are purely domestic in nature, it is very hard to not get affected if there is a storm brewing outside. So for example, if total services exports from India are 10% of GDP, if growth has already slowed from 15% year-on-year to 5% year-on-year, then that 10% drop in growth on 10% of GDP means that GDP growth falls by almost 1%. If that 5% goes to -5%, and if the US does go into recession, so the narrative that you had on the IT services names actually worsens because not only will the spate of hiring that they went through in the last 2-3 years we have to be absorbed in terms of getting them utilized. There could be a shortfall or a drop in aggregate revenues as well, in aggregate order flows in the near term. I think the 5-year, 10-year trajectory remains quite robust, but I think the near-term pressures will actually start showing up, and which could mean a further drag on growth. On the goods export side, I think a similar trajectory could happen because what we are seeing, for example, is that, say, take a plastics company, a plastics exporter from India. Now, on the domestic side, because of BIS regulations or whatever, the threat of imports coming and disrupting prices in India is very low. But in the export markets, the fact that global demand is weak and there is excess supply means that price pressures on these exporters then intensify. What we're also seeing, and that's the third angle through which global weakness can show up in India, this is the jump up in imports. So what is possible, it has started happening a bit in the commodity sector, so like chemicals, but it is possible that even in manufactured goods, we could start to see imports because there is a surplus of demand, surplus of supply in the rest of the world and weak demand. And India will have will be among the only large countries with resilient domestic demand. And therefore, Indian companies' manufacturing competitiveness will start getting tested. So this is something that, so these are the angles, these are the perspectives through which the Indian economy could get negatively affected by a global recession.
Well, we are in a sweet spot, viewers, as Neelkanth Mishra explains, but also, as he adds, there are certain concerns and worries, and at such a time, perhaps the best way to decode and analyze India's growth would be that while we continue to grow, we'll have to be very mindful and cautious of the gap. Neelkanth Mishra, thank you very much for your time with us today, decoding the state of the Indian economy and what's happening globally with us today. With that, it's a wrap on the show. If you've been, thank you very much for watching.
If you like the video, do like, comment, share and subscribe.